Good evening. Ira Epstein with your Spider ETF wrap-up, and this wrap-up is for Tuesday, and we're now sitting here at the 11th of January, 2022. Boy, interesting time for us all. Tomorrow morning before the official opening of the stock markets, we're going to get the CPI data. It's expected to have a 7 handle. In other words, 0.7% increase is what is baked into the market already. In the futures, you'll see them go crazy when the reports come out, up and down. You know, it's going to just be one of those things. I don't know how the reaction will hold up one way or the other. But the neat part about the spiders and ETFs, once you see the futures reaction, then you get that first 20 minutes or so of reactionary time in the stock market, and then it's baked in. The market's moving on to something else very, very quickly. Fed Chair Powell's testimony today, talking that his members had voted for about 3 interest rate hikes. However, he is data dependent. That was very important. He is the vote. He's the only vote that matters at the end of the day. He's obligated to listen. He's not obligated to follow what his members vote for. Independence key. Number 2. When it came to the balance sheet runoff, he didn't offer anything new that it's ready to go right away. It's being discussed. That kicked the stock market right on up because you pulled off one of the pressures that could have been there. How they run off the balance sheet, Sid. I had a friend that wrote me, he says, well, when the Fed starts selling Treasuries, I didn't ever hear them say they were going to sell. The runoff can happen by maturity, and they're just not buying more, which isn't supportive to the market. That's been under the market, as you know, the important part that has been the support to the marketplace. The Fed would come in. The other event that's taking place around the world is now in the UK and now in Spain. There's beginning to be calls to stop treating this as a pandemic, but as an endemic, which means we're converting it from that terrible pandemic we've had to something more akin to the flu season. And therefore, the social way of handling it, what you do, the closures will go away. People have to get their vaccine shots. There's a change. And if you don't see it, the seismic change is in front of you. It's not going to come. It is right now starting to happen. The fact that you have the Prime Minister of Spain talking about it, the fact that you've got the head of the UK, I think it was the education, talking about it, these are now government people starting to talk. And it's important that it starts there because they have had the first waves way before the U.S. got it, right? If not, go read. So I think you're going to hear talk about that here as well. Now remember, one of the things I invite you to do is write me right on the YouTube page as to markets you might want me to cover. This GBTC, it'll go away on Friday. I'll bring up another market and we'll highlight that each time. I'm going to keep many of the core markets. We'll see what happens. So when looking at this market, we've got a market that follows Bitcoin. It has a $55 top. It got under $30, similar to the 40% drop we recently saw in Bitcoin, and it's getting a little bit of a bounce here. When we see how the market's coming up, okay, it's a one-day bounce, doesn't mean much to me. The trend is clearly down. You have lower highs, lower lows. What I love about the swing line indicator, I wrote it 2 decades ago, easily 2 decades ago. I did it so that my son, who is not in the futures business, by the way, he could look at any chart, put this on, and tell me what the trend is and the risk associated with it. And I did that when he was about 13 years old. And it stayed with him, I can promise you, his whole life. We talk about it. So the trend is down. You can't get away from that if you believe in the pattern, lower highs, lower lows. The market has moved to the right-hand side of the lower Bollinger Band. That's very important. I'll talk about that at the end of this when live. I'm not going to take you to one of my pre-recorded videos, give you a little talk on all that. But to make a long story short, we have a bearish market that's now moved back into the Bollinger Band, and it's still embedded. I still say the pros are going to sell the rally until this market, the red reading here, closes over 21. It's at 1479. Now here's the neatest thing on these that you get in these markets. In the futures, you get to see at let's say 2 or 3 in the afternoon the settlement price, but the market trades to 4 o'clock. What you don't get in all the spiders and ETFs is you got to look at the market in the last 2 minutes and make a judgment call. If it's over 21, why not just be coming out of the market? Okay, you can always get back in. But until it does that, I think the pros are going to sell. On Apple, you've gone from the upper to the lower Bollinger Band. This is not a trend now. This is a market that has stepped out of its uptrend, and now it's just meandering back and forth. In XLF, you are certainly in an uptrend. The financial service sector looks great. It had to be happy today with what Fed Chair Powell said. I mean, what's going to make them money? It's higher interest rates and an economy that doesn't falter. The perfect recipe for the financial sector. It does you no good if interest rates are high and the economy is faltering. We're not there. We're not even close to that. You have higher highs, higher lows. I think the pros are buying these pullbacks. I teach how to do that in my enhanced Bollinger Band course. Disney, you've got a downtrend, but the market is over the red line, which is the 18-day average of closes. Trend down, bias up. Why bias up? Very simple rule. When the market's over the 18-day average of closes, I have an upside bias. It means the only thing I want to do on the short side, the only thing I want to do is use being sell signal to come out of longs, things I had bought. Got it? Not looking to be short. That's what it is saying. Momentum is overbought as can be. Nothing to do there. Then we get to the meta platforms. They have been bearish and you've hit your downside targets. You're now at a key resistance numbers. Right here at the 18-day average is the key resistance. You don't want to see the price, in my opinion, over 337. I think the pros will sell into that. They'll risk $1 on the trade. It doesn't work. They'll say goodbye. If they get it off and they don't get stopped out, they'll look at 322 again. Okay, that's how I think they're going to view the market. When we get to the industrial sector, you've had the trend down. I think you can see that. Watch here. You went right to the 18-day average of closes. Again, that keeps the bias up because you're over it, and you're just bouncing against it. No trade setup at all. The market had an embedded reading. It lost it, and that often means you go back to that line in the sand, and you figure out what to do next. In the semiconductor, the market fell right into all-time key support, and it's holding it. This is what I call key support. The combination, ideally, of a key moving average and a lower Bollinger Band when they're hit, like they did there. I think that if you're a short seller, and again, you don't have to agree with me. My technique on being long and short is not what other people necessarily do or even think of doing. There's people that were playing this, but I think as a group, people that understand Bollinger Bands, they understand, why are you pushing against them? 95% of the time, you're going to stay in the band. And there's an art to understanding, are you narrow in the band? Are you wide already? The wider the band, the odds don't figure you staying out of it. So you get down to something like that, and I think there's short covering that shows itself. It's really that simple. Home builders, why would you want to be long this market with interest rates going higher? I know you're going to tell me about the shortage of them, blah, blah. I hear all of that. But the simple fact is that weighs on the market here too. Not today, yesterday. You got down to the Bollinger Band, the 100-day average, just like I showed you. I think that's where the smart money comes out. That does not mean they're not going to sell this market again to go short against that 82.94 level. On the energy sector, whoa, what a breakout to the upside with now an embedded reading. It's very difficult to buy it up through there. You don't buy, I teach, let me put it this way, I don't care what you do. I teach that you don't buy over an upper Bollinger Band. And you'll say, well, Ira, look had I bought over that band, it's still going higher. And I'm agreeing with you. It's a sucker play. Because in time, you'll tell me I'm going to sell it under that band. I'm going to sell it, and it just pops back. for the 1 or 2 times it gets you like that. The idea of markets is to trap you into the wrong things. When the easy money hitting that band up there, and that was what I call my interpretation of the easy coming out, yes, you don't catch that. Who said there aren't other trades in other places? Gold miners traveling between the upper and lower Bollinger Band in search of direction. What the market is praying is that there's an inflation scenario at hand that doesn't harm the economy, that lasts enough like it did early last year to get the gold market finally moving up and able to stay up. Remember, we did go up to the, $2,000 level. So that's what it's hoping. It's not there on this chart, though. This chart is still bearish, and I think the pros are looking at this area here at $31, and they're saying, okay, if I sell there, I'm wrong. If you get over 32.03, that would break the pattern, but the trend is down, bias is down, and I'm not telling you to sell now. I'm saying I think they sold it on the way up there today. In GLD, market fell into the 100-day average, 18 and 200, and held it. That's impressive. The market doesn't seem to want to go down. The question is it's unable to get over that Bollinger Band and stay over it. A difficult market at the least. I really like XME. I have given you my reasons why over and over. My subscribers know it. And this market is just one where if I'm a type person that says the world is not going to fall apart. We're going to get through Omicron. There'll be headwinds galore, especially now as it's peaking. We know what we're dealing with. China probably going to go into more zero tolerance as now other cities are getting it. They may shut down some factory use at that time, and that could hurt it temporarily. But in the long run, no. I think that we'll go into an endemic, just the way I started this off tonight. And I think at the end of the day, the world needs the products, and away you go again. And I think mining is interesting based on that. Copper proves my point. Look at how it's breaking out. Now, this is the first day where the market closed out of the Bollinger Band, but at the very high. Give me one more day like that. Higher high than today, higher close than today. I get excited. Not to buy over the band, but that's a breakout to the upside. TLT. So on the downside, away you go. Now, have you watched the outflows of money? Outflows of money in this. It's been phenomenal. And how the market's coming up now. Okay, now we're still embedded. Any reading tomorrow over 21 sets the stage, if that comes, to get back up, especially towards that 18-day average through the 200. The first resistance is going to be the 200-day average right there. We'll see what the market does after we get that morning CPI data. And in the euro currency, I think the play, especially futures, work today. And now the question is, can we come out of this band that we formed, a very difficult band to trade with? As I told you, I created an enhanced Bollinger Band course that teaches you 3 ways that you're looking at Bollinger Bands, 3 different things you're going to use. Moving averages, the band itself, and a momentum oscillator. They all fit in a way you haven't, in my opinion, seen before. The idea here is that you're looking for ways when you lock in an uptrend and you go up to the number, how do you stay with the trade? How do you add on to the trade when it's going your way? It could be a bear to the downside, a bull to the upside. There's 13 videos. In the videos, I teach the technique. In the morning, I'm going to give you access for 2 weeks so you can see my morning videos and watch it as it's unfolding. And I'll give it to you both in the Spider and the Spider ETF video along with the futures. I'll be happy to give you both as the trial. I'm going to hammer home to you how I use this. There's always a play. I've yet to see with all the charts we're covering that there's some not using this method. And right now there's more than you can imagine. And it starts drilling in and you go, you know, wow, look at that. That's giving me an edge in my thinking in the market. You do with it what you want. My job is to point things out to you. You're pulling your own trigger. I don't manage people's money, anyone's money. So that's not what I do. My job is that I want to be your go-to guy in the morning. Look, here's what he's showing. Here's an inside day. Here's that outside day formation. Here's the market embedded again. Here's the market holding this longer-term trend on both the daily and the weekly. I throw it to you every morning in 20-minute videos that are easy to get through because you can jump to the sections you want real easy. The course is not expensive. It's $90. Guess what? The charting software is $60 a month. My updates, because you're going to get them to both, would be more than the two of them combined, $28 a month. You got $88 on a $90 course. You tell me. Go to our website to get this at www.iraepstein.com. Let me make that clear to you right here. And it's under the word education. If you have any questions, get to my staff. They'll work with you on it. My goal is to teach. You decide, do you like what I've taught? I'm Ira. Have a good day.